This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Narshil D'Souza and joining me, Rima Tendulkar and Surbi Upadhyay. Well, morning, ladies.
Good morning.
Bit of a muddled-looking screen this morning. Good Wednesday, halfway through the week. Let's see how this goes.
We've got some big cues as well lined up, right? The RBI policy, the US CPI inflation, just stuck right in the middle between the bulls and the bears, it feels.
Yeah, absolutely. And then you have all of this global data and some of these global developments
Seasonal downgrades.
which are just adding to the twists and turns in the plot. But the plot is interesting, and that's what matters, Nigel.
Well, indeed. But, the global cues are a little bit muddled, which, could affect and could weigh on sentiment as well in today's trading session is what I think. But I think let's take stock first up.
Yeah. Okay. Well, so the headline that we're all really referring to is basically this, that banking fears have returned to Wall Street. What we had yesterday was a series of downgrades coming in from Moody's. Now, these are obviously not the big U.S. banks. These are mid-sized U.S. banks. And after the whole SVB fiasco and Signature Bank, this is the next time we're hearing it. So there was a roller coaster ride on Wall Street. Indices were down. The Dow was down, for instance, almost 450 points at one point in time. Then it recovered. The names of the lenders are on your screens, and these are the ones that have been downgraded. I just want to, and then there is a potential downgrade. I mean, some have been placed for a potential downgrade in the future, and those names are even more interesting, which includes one of the bigger ones, Bank of New York Mellon, State Street. So these are some of the ones where the downgrade hasn't happened now, but they have been placed on watch. Anyway, what is Moody's saying? That's more important. I thought I'll just put that out as well. U.S. banks continue to contend with interest rate and asset liability management risks with implications for liquidity and capital. Many banks in the second quarter have shown growing profitability pressures that could reduce their ability to generate internal capital. This comes as a mild U.S. recession is on the horizon, and there are asset quality risks, particularly in the commercial real estate portfolio. Just thought of putting this out there. I mean, what's the thought process and the rationale? Basically, Moody's feels that there could be asset quality risks down the line as this mild U.S. recession comes upon us. Now, the market digested it really well. The headline seemed very, very negative. But as I said, on the equity side, we had a bit of a recovery on the indices, though, of course, the closing was still negative. Not much of a reaction in the money markets. The US 10-year is still hovering around the 4% handle. And the dollar, again, no huge sort of reactions, outsized reactions. The DXY is still around 102.5, and it's anyway been strengthening over the last couple of weeks. That story is intact. So nothing very different to report over there. There's more news from China, and Rima will get to that in just a bit. But for us here in India, like Rima, as you said, I think it is going to be all about what the Reserve Bank of India has to say. We have seen those inflationary pressure in our food prices. I think the consensus on the street still is that we'll get a status quo policy. But we really have to wait and watch. I mean, the commentary, given the global developments and our local issues with food inflation, the commentary gets really important. And for the indices, I think some of the levels become really important. For the Nifty, the 20 DMA, and the recent low in the current sort of setup, which is closer to 19,300. That's what we watch. The 20 DMA comes in, much ahead, 19,644. Bank Nifty is already below the 20 DMA. So the 50 DMA is more important for the Bank Nifty. But I think if we can hold the range, the bulls will be probably happy with that today.
Let me just pick on the point about China, right? Because as US, India grapples with higher inflation, China is grappling with disinflation. So the July CPI print has come in less than what the street was anticipating, but it's a contraction, minus 0.3. Again, this is slightly better than what the economists had polled, but this is the first time in 28 months that China's CPI inflation print is a negative. So the street is worried that this faltering economic recovery in China is leading to disinflation. Asia is broadly on the back foot. Again, the cuts are not deep, but you are seeing red on the screen when it comes to Hang Seng. That's down 0.4%. Nikkei is down close to about 0.5%. And the Chinese markets too. That's the Shanghai index is currently also lower in trade. Let's pull up the GIFT Nifty before we proceed and talk about the Indian markets. The GIFT Nifty, I think, is suggesting an absolutely flat start. It looks like a tussle between the bears and the bulls, but we've been trading in a very narrow range. And I guess the market just want that RBI policy to be out of the way before getting some more direction in. And plus tomorrow, Post-market hours, you've got the US CPI inflation print. The level we've been talking about is the 20-day moving average. For the last 2 consecutive sessions, that's on Monday and on Tuesday, the Nifty faced resistance at that level. Currently, the 20-day moving average stands at 19,644. So we're still some distance away from that level, close to about 70, 80 points currently. But watch out for the 20-day moving average on the Nifty. A quick word on the flows. Yesterday, the DIIs bought 537 crore. The FIs sold about 700 crore in the cash market. Remember, the flows picture has been skewed by a lot of block deals which have been taking place. But just to put on the board, the FIs have been selling every single day in the month of August, and now their net August outflow stands at nearly 5,500 crore. Today is also a results-heavy day for our markets. No Nifty company reports numbers, but you've got 11 F&O companies and some of, widely tracked ones with high interest like Bata, Berger Paints, PI, Granules, IRCTC, Z Entertainment. These are the numbers which will be reporting numbers. These are the companies which will be reporting numbers.
Well, that's right. Today is that kind of day. I think the bulls will want to defend the lower levels and get into the big events and say, okay, we live to fight another day. Because you have crude oil prices very uncomfortable. Just a month or so ago, it was in the mid-70s. Now we're talking about it being in the mid-80s. The dollar index as well is stronger, and that 20 DMA remains elusive both on the Nifty and the Nifty Bank. Now, institutional flows, well, they've been sellers for close to around 9 sessions. That's the FIs. And we haven't seen this sort of selling all the way since March 2023. In all, they've sold close to around $1.5 billion odd. So 9 sessions on the trot. We haven't seen this in many, many months. But I think what's more important now is to start looking at the net institution number. And yesterday, that was down only around 170 crores odd. When the DIs, they pump in some money, and when the net institution number doesn't go beyond that 500-800 crores odd, I would say that's par for the course. The problem is when the FIs sell big time and we don't get any counter flows coming from the DIs, and when that number balloons up. Now, what do the FIs do in the F&O market? Well, they covered some short positions yesterday. They lightened some longs as well, though they continue to remain net short on the markets. Let's focus on the FI net short positions and their gross participation as well. The net short positions just a few days ago was at around 40,000 contracts. That's come down by a fourth. It's come down to around 12,000 contracts odd. So some part of that short covering from the time we visited that 19,300 odd, that's come off, because the short positioning has come down substantially. But the gross participation of the FIs in the F&O market or on the index futures itself has come down drastically. It's at now the lowest levels we have seen in the last 1.5 months odd. The total contracts, it's the gross. The long as well as the short positions, you add both of them, it's at around 1.8 lakh contracts. That's much lower than what we saw, say, just 5 sessions ago when it was around 2.1 lakh contracts. Now, moving to the options data, 19,600, 19,650 call. Both of them, between them, they added close to around 90 lakh shares odd, which brings us to the levels. Now, on the upside, 19,650, that's the near-term resistance level. While on the downside, since you have the highest open interest on the put side at 19,500, 90,460, that becomes a crucial support zone. The Nifty Bank, well, yesterday it showed signs that it wants to move higher, but it faced some resistance at around 45,100 odd. So the 50 DMA becomes important, and keep in mind, yesterday the 45,000 put as well, we did see a fair bit of open interest. For the next 24 hours or so, I think the bulls will want to wait by. We could be in this consolidation phase, and then we'll break out of that 19,300 to around 19,650 odd level. For starters, well, it will be more or less flattish, but 2 big triggers. Tomorrow, the RBI commentary, and later in the evening, we'll have the US CPI print. Then maybe we get more direction. Either we break that 19,650 on the upside or revisit the 19,300 on the downside.
Today is also some mid-cap select expiry,
yeah,
right?
That's
Does
right.
that really...
No, but that's, that's been happening for the last... Now you have expiry every day, Rima.
Every day, no?
Yeah. There's something to play every day. But I completely concur with Nigel. I think for today, if we can just hold the lows of this range, I think the bulls will take that with both hands, perhaps.
Yesterday's trading range was just 100 points in the Nifty, one of the lowest that we've seen, just about 0.5%. But let's kickstart the show and tell you what we've lined up for you in the next 30 minutes. So we'll get you updates from the markets across the globe. Arvind Sanger of Geosphere Capital Management will join in to discuss the global trade setup. Later on, our research team will join in for the CNBC-TV18 list of top 10 stocks for the day. And at around 8:30 a.m., we will do a fundamental stock analysis with Deven Choksi of drchoksi.com.
Okay, on equities, we have a call coming in from Mahesh Nadurkar of Jefferies, who says the Goldilocks position for Indian equities is getting questioned with crude rallying, China gaining some traction, rising India CPI, and yields moving up. He says FPIs have turned net sellers, and India has underperformed MSCI EM by 3.2 percentage points over the last month. He says while the near term appears weak, there are more signs of capex upcycle picking up. Mahesh adds that their preference for domestic cyclicals, financials, industrials, property, and mid caps stays, and they move 3 percentage points from RIL to banks in their model portfolio. So medium to long term looks good, near term maybe a little challenging. That's the Jefferies view.
Interesting, right? We just had Morgan Stanley upgrading or making India the top spot in the emerging market basket. And then you had BofA yesterday, which raised the Nifty target to 20,500 by December end. But you've got Jefferies today, which is throwing in a bit of caution. Let's get you the money market views then. Kunal Sudhani of Shinhan Bank says the US dollar regained its status after Chinese import numbers plunged even worse than during the pandemic. He says this triggers some risk aversion flows with the US dollar as a safe haven and US bonds being bid. He says mixed comments from Federal Reserve officials maintain financial markets in a cautious mode. For the USD-INR pair, 82.65 against the dollar acts as a support, while 83 acts as a resistance.
On bonds, Neeraj Gambhir of Axis Bank says the 10-year benchmark bond traded in a range of 7.15 to 7.22% last week. He says the rise in U.S. Treasury yields and crude oil led to a surge in domestic bond yields. During the week, he adds U.S. Treasury yields rose on the back of higher than expected private payroll data and increased bond supply. However, he says last Friday, lower than expected non-farm payrolls data led to a sharp fall in U.S. Treasury yields. He's expecting the 10-year benchmark here in India to trade in pretty much the same range, 7.12 to 7.22% ahead of the MPC meeting this week.
Well, we've a lot of stock-specific action to track for you. Get to that in just a bit. From now, for the time being, let's run you through our top 10 list. We're looking at Coal India, Siemens, Birla Corp, Oil India, Phoenix Mills, data patterns, and multiple blocks that happened yesterday. So all of them will be on our radar. We also have some other stocks, Happiest Minds, Idea Forge Technology, and Aarti Industries. They are stocks that could be reacting to negative news flow.
Okay, more on our top 10 list in just a bit. But let's get a conversation going on all these global cues and how they impact India. Arvind Sanger, managing partner at Geosphere Capital Management, is with us on the show this morning. Arvind, thank you so much for staying up and taking this call. Always great having you on the show. So, okay, let's get the banks discussion out of the way because we have all this news coming in with this Moody's downgrade, and they've placed a couple of the other lenders on a ratings watch. The markets seemed to kind of digest this yesterday and take it in its stride. Equities also recovered a bit. Bonds didn't do too much. But do you think the reaction's over and done? It was a one-day event, or could this now continue to become a bit of a lingering reason why maybe people take some money off the table?
Well, the last time the rating agencies were early was never. So the idea that the rating agencies are going to teach the equity market something that they don't already know, or that macro investors already don't know, is laughable, right? So the reality is that people have been talking about this, crisis in commercial real estate for several quarters now, and we know that occupancy has fallen a lot. And cities like San Francisco and New York, there have been multiple bankruptcies, and there is exposure to that. So look, this is a problem. This is a well-known problem. I don't think that the rating agencies are early to the party. The market, I'm not saying will not see some hit from this in the coming months and quarters, but I don't think there was anything new today that we haven't talked about before.
So you're not seeing a big fallout of this Moody's downgrade. Arvind, morning, Rima here. What about the China data? One, the trade data slumping, and two, China's CPI pointing to disinflation. How would you read this, and what would be the ramifications for emerging markets in terms of flows, economy, etc.?
Well, China has been actually the biggest negative surprise of 2022. I'm sorry, for 23. 22, it was a negative surprise, but in 23, what's surprising is that, you would have expected with the removal of zero COVID, there would be the normal recovery that we saw in every other post-COVID economy. But what we are finding is that China has structural problems, demographics, bursting of the housing bubble, business confidence, unemployment levels at the youth level, which is extremely high as 40%. and you have an export, slowdown from Western consumers. Plus, you have the structural headwinds of companies looking for, removing dependence on China or reducing dependence on China with the China Plus One strategy. So there are many, many headwinds China has, and it's clear that the policymakers don't have any magic wand. They can't reverse demographics, and the business confidence they've been unable to do, partly because they've cracked down so many private industries that President Xi, under his leadership, they've cracked down on. So I think that China's problems are becoming, harder to solve. I do expect, and we all expect, that China is going to throw some money at the problem, but I think they don't want to create a bigger debt bubble than they have. There by some estimates, 220 to 250% of GDP is debt. So I think those problems are not going away. So I think that China is going to be a unique headwind for growth, but I think China's loss is India's opportunity. At the end of the day, I don't think India or emerging markets get hurt just because China has its own unique problems. I think people are looking for other emerging markets which will have growth, and other markets. It doesn't matter emerging or developed. And India is one of the ones that is, I think, not as much impacted by China. India has its own short-term challenges, but I think the structural problems are clearly unique to China.
Hi, Arvind. Good morning, Arvind. So how do you approach the Indian markets then? Clearly the longer-term story looks good. In the near term, this crude oil spike, maybe valuations, could make investors a little bit jittery. But what are the themes you're bullish on in India?
Yeah, I think, look, India has been a story that's been favored by emerging markets investors, us included, for the last couple of years. Evaluations, this is always a challenge, right? If everybody gets bullish on something, things get expensive, then it takes a little while to digest it before earnings. Look, the quarterly earnings were good. We're finding, bottom up, a lot of interesting ideas, whether it is in, housing or housing-related material suppliers, or whether it is in, things like travel-related industries, or it's in other special situations, anything related to recycling, green economy. There are many things that we're finding that are interesting, that are niche, that are not making a big global macro call. But I think, domestic capex is an area that we continue to be bullish about. We have selective exposure there, but we think that's coming. I think that cycle is coming. The PLI scheme, is a positive, but I'll tell you a negative. I'm a little concerned that India doesn't turn the PLI scheme into a protectionist license ranch. And this, sudden banning of imports of computers, of PCs, was a kind of thing that I think is a negative, kind of an approach versus a more positive approach of creating the framework for companies to come to India and invest because the market makes sense. And therefore, I think India needs to be careful. Those kind of actions, I think global investors and domestic investors don't see as a sign of strength, but as a sign of somewhat regressive economic action. So I think there's a lot going for it. It's just up to India not to do things that might seem short-term to be great, but would have long-term structural negative implications.
Interesting point. Okay, we'll keep that in mind. Though, of course, the rationale being cited here is that some security angle to its security concerns. And then, of course, the larger Make in India game plan. We could do that with mobile phones. Let's see what happens with laptops. But your point is taken on board. Arvind, great speaking with you. Thank you very much for joining in, and we look forward to the next Connect. Quick break on that note. We'll come back with our list of top stocks to watch on the other side. Welcome back. Here with us on Bazaar Morning Call, and we've been telling you that the global setup is a little, difficult to say the least. So the start is expected to be a little soft. But right now it's time to take a look at all the stocks that should be on our radar. And our team is standing by with the CNBC-TV18 list of top stocks to watch for exactly that. Guys, good morning and, good day to all of you. Nigel, let's kick it off with some good news. I think Coal India gave us that yesterday.
Well, that's right. Coal India's numbers were good. It was a top-down beat from Coal India. So on the top line and the margins as well as the profitability, it looked quite good. Let's run you through the key reasons, though. Since it was a top-line beat and we already have the volumes numbers with us, the blended realization, that came in much better. Novoma was working with a number of around 1,680. It beat their estimates by close to around 90 rupees. And the FSA, which is bulk of their sales, more than 85% of their sales out there as well, you had a beat out there. A couple of factors here. One is they're taking a price increase. And the second factor is a better mix, higher amount of sales to non-par. That's what helps realization. So that's the reason why it was better. And e-auction as well. Yes, the prices did come down, but they didn't fall as much as what the street was working with. So the premium to FSA sales were in excess of around 100%, came in at around 140% odd. So realizations was the key reason of the beat. The margins, well, yes, they did expand on a year-on-year basis. Though they expanded more than what the street was working with. Though on a year-end basis, it's lower because employee costs did take a bit of a hit. They're taking a wage revision. So that explains why. On a year-on-year basis, it's lower, but it's still better than what the street was working with. Coal India opens up in the green. Vivek joins us to tell us about Siemens. Morning, Vivek.
Well, good morning. We are looking at Siemens. Siemens largely inline set of numbers. However, one thing that's missed the street estimates as well as our poll has been the fact that margins have been a slight miss. Now, Q1 order inflows, however, continue to remain the bright spot above the 5,000 crore mark for multiple quarters in a row. And, given the fact that it's come off a high base, largely expected to be tepid. However, the number of 5,000 crore is something that analysts have taken a bit of, hope from. Looking at the numbers themselves, the revenues have stood at around 4,873 crore, in line with our poll. And on a year-on-year basis, it's up almost 14.5%. Profitability too largely in line, coming at the 450 crore mark. EBITDA 567 crore versus our poll of 563 crore, again largely in line. However, EBITDA margins have missed by around 60 basis points. This on the back of higher costs actually going ahead and denting margins. Now, what UBS has to say is that UBS says that it's a top line beat of almost 7% as far as the Siemens revenues are concerned. However, according to their EBITDA margin poll, it's 100 basis points miss. New order intake run rate remains above 5,000 crore for the past 3 quarters. So again, that is something that they've highlighted as a positive.
Okay, thank you very much for that. I'm watching for happiest minds. In a nutshell, the revenue growth was strong, margins have declined, and the FY24 revenue guidance is in question. So these are the 3 key points. Let's start with the top line. The top line growth looks good, 3.5% quarter on quarter. Year on year, it's a growth of about 13-14%. But margins have fallen on a sequential basis. Now, the company in its release has said that we're on track to achieve a $1 billion of sales guidance by 2031. Now, this requires the company to grow by 25% every year, which will be done via a mix of organic and inorganic acquisitions. For this year, the company was looking to do some acquisitions to help get that growth. Significant acquisitions is the word they've used, but those acquisitions have not closed as of now. So the company has said they will update the guidance target in October based on the M&A progress. So whether the company achieves their FY 25% top line growth guidance for this year depends on the company closing in an acquisition of their size. So that's about happiest minds. What about Birla Corp?
Birla Corp, the numbers actually were mixed, but we're going with green out there because there's an improvement in what you've seen. And Mukut, there is some kind of improvement that we're seeing out there. So on the top line, there's a growth of close to around 9% odd. The EBITDA number, will that improve by close to around 15%? Now, some on the street were expecting an EBITDA number of around 320 crores odd, while others were expecting around 260, 270 crores odd. So they come in the middle of that. And there is some mild margin expansion. Power and fuel costs, that's cooled down. That's clearly worked in their favor because out there, in fact, there's a compression of close to around 17%. Though the profit number did see some pressure because of higher depreciation since they've commissioned a couple of facilities. And since the debt has gone up, that's why, in fact, in the PAT number did see some compression. Volumes, though, they continue to ramp up, and the EBITDA per ton did improve a little bit to around 664 rupees since it has valuation comfort, going with the tinge of green on this one. But let's hop across to Sonal. She's standing by to tell us about Oil India and Phoenix Mills. Sonal?
Good morning, Nigel. Let me start with Oil India. So it was understandably a decline on a quarter-on-quarter basis because of lower oil prices and gas realizations were capped as well. But margins expanded this time. So revenues were down 18%. EBITDA was flat at 2,400 crore rupees. Margins, they came in higher by around 1,000 basis points, but profits were down 10%. Crude oil realizations came in at $76.85 per barrel. But going with green here because now crude oil prices are at $86 per barrel. So that bodes well for Oil India. If we talk about Phoenix Mills, it was a good set. The revenues were up 52%, EBITDA up 52%, margins came in at 61%, profits were down 61%, but that's because in the last quarter there was an exceptional income. Strip of that, numbers look good. Going with green for Phoenix Mills.
Okay, so Phoenix continues the good run from the real estate side. Sonal, thank you for that. Back to Vivek. Vivek, I think you're looking at data patterns and IdeaForge, my God, there was a bit of a crash landing for the drone in this quarter.
Well, you're absolutely right. So first, let's have a look at data patterns. Very good set of numbers from the company. Even though, profitability was aided by higher other income, even operationally, it's been a strong quarter for the company. Revenues higher by almost 31%, coming in at close to the 90 crore mark. EBITDA, core EBITDA has jumped up almost 31% on a year-on-year basis. And despite that, margins have been maintained close to the 31% mark. Profitability higher by 86%, aided by higher other income. Along with that, the company has also given a 2-year outlook, and it's a strong outlook that the company has given. They're expecting top-line growth of almost 25% CAGR. Along with that, they're expecting sustainably higher margins of close to 40%. Along with that, when you're talking about the current order book, quite strong, over 1,065 crores. This includes the orders that the company has received in Q2 so far as well. On the other hand, like you mentioned, IdeaForge, largely weak set of numbers as far as Q1 is concerned. Revenue is down by 2.5%. However, the core EBITDA has disappointed, down by almost 48% on a year-on-year basis. Margins to 29.4% versus over 55% last year around. Profitability lower by 54%. Cost of material, employee benefits, all of these have gone ahead and impacted the operational performance of the company this particular quarter.
Okay, all right, got that, Vivek. Thanks very much. Let's go back to Sonal, who's looking at Aarti Industries. More of the same here when it comes to chemical companies, Sonal?
Oh yes, Aarti Industries saw sharp decline both on a YOY and on a quarter-on-quarter basis. Now remember, Aarti Industry caters to segments like dyes and pigments, the discretionary side, which is 50% of their portfolio, and that is something which has been facing headwinds, and that's why revenues declined 12%, EBITDA was down 30%, margins declined 300 basis points, leading to a profit decline of almost 48%. Even on a quarter-on-quarter basis, there's no relief. Revenues down 15%, EBITDA down 21%, and profits down 52%. Management commentary in this case will be important to understand because now there's some relief in the pigments industry that is in the that's in quarter 2. So that is something we'll be watching out for.
Okay. Let's go across to Nimesh to get a handle on the big block deals of yesterday. Who were the buyers? Who were the sellers?
Hi, Rimas. There was a long list of large block deals. A couple of them are part of my deal sheet chatter as well. I'll start with Minda Corp, confirmation of a clean-out trade. PHI Capital has sold its entire 5% stake via block deal. And in terms of buyers, Society General and ICICI Pru were some large buyers. The second is Ganesha Eco. Even there is a confirmation of a clean-out trade. So MCAP India Fund sold its entire 3.5% stake in a block deal. PNB Paribas Arbitrage Fund was a large buyer there. A couple of other PE exits as well. The first one is 361, which is erstwhile IFL Wealth. In there, General Atlantic sold close to 40 lakh shares at around 500 rupees per share. Some domestic mutual funds were buyer there as well. Bikaji Foods, again an interesting deal where Lighthouse sold close to 35 lakh shares at an average price of 480. And the big one was Inox Wind. The promoter entity sold 1.4 crore shares by block deal and some large funds bought there as well. So domestic mutual fund was buyer in most of these large blocks, but there were two clean-out trades, which is Minda Corp as well as Ganesha Ecosphere.
Okay, all right, got that, Nimesh. Thanks very much. Block deals back on the radar. Let's quickly recap our list of top stocks to watch. The ones that have positive news flow are Coal India, Siemens, Birla Corp, Oil India, Phoenix Mills, Data Patterns, and of course a lot of the multiple block deals that are keeping stocks in focus. The ones that have negative news flow around them this morning are Happiest Minds, IdeaForge, and Aarti Industries. Okay, let's add one more stock to watch in our list, and this is Adani, basically the Adani Group, particularly Adani Wilmar. Now, this is a Bloomberg report. Bloomberg is stating that Adani Enterprises has been considering a potential sale of its 44% stake in Adani Wilmar. The conglomerate is exploring selling its stake in its Mumbai-listed consumer staples joint venture with Wilmar International, perhaps freeing up potential capital for the core business. Bloomberg reports that Gautam Adani and his family may retain a minority stake in a personal capacity following a sale. CNBC-TV18 has not yet verified the report independently. We have reached out to the Adanis for a comment, and we're awaiting a revert from the group.
Important news there. But let's go across now to Manisha to get a roundup of all the action from the world of commodities. Manisha.
Well, thank you so much for that. I'll start with the crude oil prices, where we are holding the 4-month highs between $85 to $86 a barrel. The EIA has forecasted oil global supply deficit in 2023, and that seems to be supporting. At this point in time, the reason the markets are wobbly is because there is strength in US dollar. The China trade data that came in yesterday wasn't so great, and the China inflation numbers also have continued to decline for the month of July as well. This is a 10th straight decline coming in for inflation, and that weighs onto the market demand forecast as well. So is the reason you're looking at a bit of a decline coming in for the crude prices. But it's a definite decline for the metals as a sector. Here we are looking at copper prices trading at a 1-month lows. Steel is trading at a 2-month lows. The gold and silver prices have declined to a 1-month lows as well. What the markets are waiting for right now is the U.S. official comments. That would come in plenty today and tomorrow. And the U.S. CPI numbers come in tomorrow as well. So those inflation data also is what the street will react to.
Okay, thank you very much for that. Get into a break. On the other side, we'll be joined by Deven Choksi, Director at DR Choksi FinServ, to discuss some fundamental stock analysis. Later on, we'll also be joined by Vivek Parthiban, CFO at Kaplan Point, to discuss their Q1 performance.
Welcome back. You're tuned in to Bazaar Morning Call. You're on CNBC-TV18. Well, let's get chatting about a couple of stocks that we just discussed in our top 10 segment. Let's analyze some of those numbers. Deven Choksi, our director of KR Choksi, joins us on the show. Hi, Deven. Good morning. Thanks so much for joining in. Well, give us a couple of details in terms of the numbers that we got overnight. And let's start off with the Nifty component. That's Coal India. Numbers look quite good. Valuation-wise, it has some comfort. What's your view on the stock? Because e-auction prices have cooled off, but volume growth is looking very, very good.
Yeah, good morning, Nigel. I think this is probably one of the best times that the Coal India is enjoying. Given the kind of revamping of the operations that the government has done in form of extracting the coal out of the mines and giving it, I think, just in time to the power industry is something which I think this company has remarkably achieved. So we were hoping for higher amount of volume growth, and which got confirmed yesterday when the results came out. Even though I think there is good possibility that e-auction would end up fetching better yield, I think in selective quarters, I think you might see some amount of disappointment on that particular front, but that doesn't take away the larger picture for the company as a whole. In my viewpoint, I think given the strength of the mindset they have, given the strength of logistic distribution that they have created, and given the kind of possibility that we are enjoying today in form of higher amount of efficiency in providing coal, I think this company would steadily continue to perform better on a quarter-on-quarter basis. Maybe the numbers will keep changing. And as you rightly observed, I think the valuation-wise, this particular company has been giving extraordinarily good amount of comfort, because initially the investors have remained reluctant in putting money into the fossil fuel-related businesses, and that's where Coal India was probably victimized. But as the realization keeps coming in about, I think, requirement of coal for the generation of power, and I think also the maturity coming in form of decarbonization, I think that part is basically allowing the investors now to once again allot money into such businesses. And I believe that Coal India holds potential for attracting larger amount of money. So obviously on one side operations have been regenerated, and on the other side you are having the possibility of higher amount of money coming in the business from the investors. Both this part, and at the same time the valuation is not so expensive. So these are some of the points which are making this particular company available currently for adding into the portfolio.
Devin, morning. What about Idea Forge? It was the blockbuster listing, issue price 672. Straight away doubled on opening day, listed at 1300. Now it's down to 1000 and I think 75, 76. Numbers are weak. Margins have fallen from 55% down to 29%. Profits consequently are down 54%. And plus there was those news reports about how India has barred makers of military drones from using Chinese parts. I'm not sure if Idea Forge gets impacted, but how would you put all these news flow together and suggest what to do with the stock from here on?
Good morning, Rima. Well, I think this is something which is not very surprising to me particularly. The day on which the company got listed, I think this was a view which was very clearly put across, that the valuation-wise, you can't be pricing the company so expensive. And if you would price the company expensive on the listing day on the market, then possibly I think the investors will not be able to make money, and that exactly is playing out. I'm not per se against the business and the possibility and the potential that this business is offering, but I have a strong understanding on this particular subject that any business, I think, which is connected with railways or the defense for that matter, I would think that the margins are going to be operating very, very, very tight. And that is where probably I think the companies will have to demonstrate extraordinary amount of skills in beating those margin pressures. In many cases, I think that is not their reality. And we are yet to study, I think, many number of quarters for Idea Forge. I think this is still a recent listing. But I believe that I think, including in many other companies which are in the listed space, I feel that I think if the companies run up ahead of its profit performance, they would probably, I think, find disappointment on the pricing performance as far as the market is concerned. So in my viewpoint, I think one will have to wait before one would act into this particular counter to add into the portfolio. Certainly, they will have to demonstrate the ability to provide the sustainable performance. Then I would think that I think it would be easy for investors to walk into it. Particularly, current valuation still remains, even after the price drop, current valuation still remains far more expensive, and would probably, I think, keep myself out of it for the time being, till the time I see the profit sustaining possibilities happening in the counter.
Devin, do stay on. We've got the first corporate on our show now, Kaplan Point. Now, this is a company which makes a lot of laboratory medical equipment like vials, syringes, droppers, capsules, tablets, dry syrup bottles. Most of their revenues, about 86% of their revenues comes in from Latin America and Africa. Only about 14% of their revenues come in from the United States. They reported their Q1 numbers, look like a good set. In Q1, the revenues have gone up, margins have improved to 32%, and even the US business, which is currently about 14%, has seen a pretty good growth of about 12%. Vivek Parthiban, the COO at Kaplan Point Laboratories, is now with us on the show. Vivek, morning, and thanks so much for joining in. First, if you could just break up the top line growth into your key markets, how much did Latin America grow? How much did Africa grow? And for US, I think you had given a guidance of 300 crore of revenues this year. Are you on track to achieve it?
Yeah. So as it stands, like you said, close to 86-87% of our current revenues come from Latin America. And the US is most of the rest. About 12-13% of the rest is from the US. This quarter, a substantial amount of the growth has come in mostly from Latin America. As we've given in our guidance, Q1 and Q2 for our US would be a little bit more moderate because we have an additional spare capacity in the form of a high-speed vial filling line coming in by October. So Q3 and Q4 for our US business will be substantially better compared to Q1 and Q2. But we've always been quite consistent with our numbers. In fact, because close to 90% of our business is private market based, so there's a fair amount of predictability in our growth and in our numbers. We're quite confident the US targets also would be met by end of this financial year.
So 300 crores US revenues by FY24, right?
That's correct, yes.
All right, Vivek, we'll get back to the numbers and the outlook from here on. Pfizer's injectable plant has been impacted in the United States due to the thunderstorm. Now, around 12 products are expected to be impacted. Is there any kind of overlap with Kaplan? I ask this because I want to understand whether or not there's an opportunity for the company to go ahead and supply.
Yeah, so there is an overlap for a couple of products, but if you read into the situation a little bit more, I believe the impact might not be as high as it was initially feared. I believe the impact mostly was in the warehouses, and quite a lot of the finished goods, I believe, were destroyed. But I think the manufacturing capabilities of that plant continues to be okay. I don't really know too much into it, to be honest, but we don't really focus too much on occurrences like these. We need to be focused a little bit more on our long-term forecasts and what we target to achieve over this year and next year onwards. But the answer to your question is there is an overlap, and we are well prepared. In fact, today, we partner out with all of the products that we manufacture, so our partners are on the job as we speak.
But do you think it'll mean excess business, or do you think that the initial impact actually was maybe overestimated? Like the street maybe thought that there was a bigger opportunity for you.
So the public statement that I have read is that the impact may not be as great as it was initially feared. Yes.
Okay, so I guess you're not factoring any additional opportunities in. That 300 crores in the US you're talking about is X of whatever additional you managed to do with this Pfizer development, right, Vivek?
Yes. No, our guidance does not depend on what happens with other companies.
With some other manufacturer. Yeah, got that. Okay, so I want to move on beyond the US because like you pointed out that other markets are much bigger for you, Latin America, Africa. Now, you did revenues of almost 1,400 crores, a little over 1,400 crores last year. Now, this year you're saying you should be getting 300 crores from the US. Let's talk about the rest of the world, the other big markets for you. What is happening there? Our colleague Ekta, for instance, was telling us that you're also looking into getting into more complex spaces in oncology, I think, ophthalmology. So if you could just tell us what the opportunities are and what's the run rate you're expecting in your other big markets like LATAM and the others.
Yeah, so we've certainly consolidated our position in the current LATAM markets where we're operating in. Obviously, our company has taken on a large capex over the last year, and then it will continue on to this year and potentially half of next year as well. We are getting into different dosage forms, different categories. Like you said, oncology is a space that we're getting into. We're also entering into the larger Latin American markets such as Mexico and Brazil shortly. We're getting into CIS markets in Southeast Asia and CIS and all of that now. So all of these put together, we feel that the next 3 to 5 years is going to be very crucial for the company for us to get into the next trajectory. What is important for us is to live within our means. We have not taken on any debt. We can remain completely debt-free. All of these capex expansion and followed up by the operational expenses, everything will be done in-house. So we feel that this is a good opportunity for us to, over the next couple of years, I think it looks positive. Yes.
So Vivek, do leave us with some guidance if you can. I mean, what's the run rate that you would hope for at a company level for FY24 and margins? You've been in this band of 29%, 32%. You're at the top end of the band. You're right there at around 32. So will this year be pretty much the same, or can you actually break out on the top side of this margin range?
Yeah, we feel the margins will remain as they are, or they might continue to go up a little bit as well, because as revenue starts to catch up, especially in our newer initiatives such as the US, you will start to see some level of boost to the bottom line. Of course, in the next couple of years, once our oncology plant and everything goes on stream as well, the revenues will continue to increase, whereas our expenses will plateau out at a certain point. So we feel the bottom line is very good, healthy as it is, but there's chances for it to go up even further.
Okay, all right. Thanks for joining in today, Vivek. Good luck with those plans, and we look forward to more connects in the future. That is Kaplan Point. Numbers have been pretty okay, and they've got plans of expansion in most of their markets. Good morning. Farmers had a fantastic earnings season, right? All the big companies, and right now we're speaking to a mid-sized one. Most of the companies are sounding optimistic. Cipla, who knows, there might be some sort of a corporate development. How would you look at the pharma rally, and within this space, what do you like?
Good morning, Surabhi. Well, I think important point, the raw material prices have remained under control, and which has allowed most of the pharma companies who have reported the results have been in a position to improve upon the margin that they have up till now produced. In earlier quarters, I think the significant amount of challenge remained with the input costs, and as a result of which I think most of them have suffered. Second important point to talk about, and where the companies have scored, they have successfully, I think, entered into some of the territories, the markets, where probably I think they were non-existent, and they have made the market share out of it. Prior to that, I think they were having a challenge on that front. Companies like Cipla, companies like Sun Pharma, who have been reporting higher growth, they have actually been able to produce so largely because of their focus on complex generics. And that's where probably I think these companies have been able to report relatively higher amount of volume and the business growth in respective segment, therapeutic segment categories as well. In my viewpoint, I think the companies have been now coming off the whatever earlier challenges, including the US FDA related challenges, and now ready to show relatively better performances. Maybe I think we continue to like some of the larger ones, including the Sun Pharma, including Cipla, in our portfolio. We continue to hold them. Not too sure immediately, I think, whether any other mid-sized companies immediately appeal us, I think, from the investment perspective. Maybe when we'll have to take a little deep dive into the subject of, I think, how the growth is panning out in those companies. But our clarity remains with Sun Pharma, Cipla, and Dr. Reddy kind of companies far more, and we are far more comfortable there.
Deven, thank you very much for joining us this morning. Today, there's also news on Lupin, where its arm has gotten approval for an eczema oil. The market size is $10 million. Get into a break. On the other side, Anuj Singhal will join in for a quick trade setup. Post that, we bring you the top stocks to watch from our technical and F&O experts.
Welcome back. Slightly subdued morning across most of the global markets. Let's go across to Anuj to figure out what he makes of it. Anuj, morning. So how do you read the setup today?
Morning, Surabhi. Well, you know what, if you look at the setup, one thing which we perhaps do a lot is to look at the index alone. This is not the market in which you're looking at just the index. You need to look beyond the index. Of course, on the index itself, it's respecting the resistance and the support, even the first resistance support, which tells you that it's a bit of a contracting market. But look at the mid-cap index. It hit fresh all-time high yesterday. And not just the mid-cap index, the mid-cap 100, mid-cap 150, micro-cap index, small-cap index. Every index is at new all-time high. So people's portfolios are doing well. The index may be struggling. And index actually is also just consolidating, not correcting a lot. 269 BSE stocks at new high, only 28 BSE stocks at new low. So it tells you that the market is still firmly in the grips of the bulls. The index has gone through time correction. The Nifty is about 2% off the highs. Bank Nifty is about 3% off the highs. It looks much bigger than that because, we're used to seeing the market move up almost on a daily basis. Time correction has also allowed the moving averages to catch up. For example, both Nifty and Bank Nifty are now below the 20-day moving average, but above the 50-day moving average. Now, coming to Nifty, this is the table that I've been presenting for last few days, and this table would come up for you again. And what you would see here is that every day the low has been higher than the previous day's low. It started with August 4th, where we made higher low by just 1 point. After that, consistently the low has been higher and the high has been significantly higher for the Nifty. So what it does is it gives you a reference point to work with, the previous day's range, which is really your support zone. So first support is 19,533. And the bigger support is 19,500. On the upside though, 19,634 is acting as some kind of resistance. That was also yesterday's high. And the bigger resistance is 19,680. If you take out 19,680, then a sharp move to 19,800 is possible. But that's a big if. On the Bank Nifty also, very interesting. What's clear is that the high has been same, almost same, around that 45,050 mark. But low has been moving up significantly. That's a good news. And yesterday, SBI and ICICI Bank ended high point of the day, which is good news because they are Bank Nifty's leaders. Let's see if HDFC Bank can start to participate. But really, 45,200, that's the level that the Bank Nifty needs to cross. If it does that, then I think you will see a big rally. Up until then, you'll have to negotiate in the small bank.
Okay, all right. Thanks a lot for that, Anuj. So broader markets, plenty of stocks doing well out there. But as Anuj says, the headline index appears it's in for a bit of some consolidation. 20 DMA remains elusive. But let's get in our technical experts. Mitesh Thakkar and Sudarshan Sukhani join us on the show. Good morning, gentlemen. Hope you're having a good morning. Well, Mitesh, let's come across to you first. What's your trade on the index first up?
Morning, Nigel. Since a couple of days, I have been advocating to wait for a bounce to sell into, and the levels which I've indicated are closer to about 19,650 on the Nifty. We haven't hit that, but we are very far away from those levels. Yesterday, I think, we got a high of around 19,634, and these are spot levels. So closer to 19,650, we'll want to short aggressively with a stop at about levels of 19,710, so about 60-point kind of a risk. But we are anyways believing that the structure is slightly on the weaker side, so we are holding put options position. But as I said, future shorting will happen near the supply pivots. Similarly, on the Bank Nifty, the corresponding levels to short futures would be closer to 45, 350, 400 levels. But otherwise, I think, hold into put options. And my belief is that eventually we will head lower. The only thing is that whether this pullback will try to fill the gap which we got last week's Wednesday. If not, then I think it'll turn out to be a very profitable kind of a trade.
Okay, got that. Stay on, Mitesh. We'll just come back. Sudarshan, good morning. How are you reading the situation today? We've been very, very range bound. Any trade on the indices?
Yeah, good morning. See, the indices have been, the Nifty has been in a very narrow range for the last 2 days. Narrow ranges generally lead to a breakout up or down. Now, because the bias continues to be bullish, I would assume that there will be an upswing in this market. And that is supported by yesterday's S&P 500 price action where the dip was finally bought into. So I would be a buyer today at lower levels, or let's say somewhere on any minor dip in the morning, keep a stop under 19,450 and then take the trade home if the Nifty closes strong.
Okay, all right. Sudarshan, thanks for your call on the index. What about individual stocks? Could you give us your picks?
Well, the individual stocks are a little mixed. Chola Finance is an intraday short. The stock has been falling consistently. So intraday short with a stop above 1,075. Glenmark, again, that pharma story continues to be very upbeat. we keep on having these pharma stocks in my list. So Glenmark is a buying opportunity with a stop under 804. UPL, which had come in my short list earlier also, is an intraday short. If you see the chart, you will see a significant bear market for the stock. It's an intraday short with a stop above 610. And ICICI Prudential is a buy with a stop under 560.
Okay, got that. Mitesh, what about you? What are the stocks you're working with today?
Good morning, Swarvi. I have more of buy calls. Manappuram had a breakout yesterday. So that's the first call. Buy here with a stop at 139 for targets of 156. PNB is a buy with a stop at 60 half for targets of around 66. A buy on Container Corporation of India, which I would recommend buying with a stop just below 700. Look for targets of 735 here. And one sell call, that's from Nestle. Keep a stop about 22,500. Look for targets of 21,700.
Okay, got that, gentlemen. Thanks very much. We'll come back to you a little closer to market opening. Right now, we have to take a very quick break. We'll come back and get the pre-opening rates. We'll also be chatting with the management of data patterns, talk about the company's Q1 performance and the outlook for the rest of the year.
Welcome back. The GIFT Nifty is suggesting a very quiet, flat opening. So let's find out a few trades. Rajesh Palvia, VP Technical and Derivative Research at Axis Securities, is with us on the show now. Rajesh, hope you're having a good morning. What would be the index trades, Nifty on the Nifty Bank, and your individual ideas?
Good morning, Rima. So looking at the setup, as of now, we are expecting that, Nifty is likely to remain in the consolidation range. The broader range, which we are looking based on the data setup, that is 19,450 on the downside, and on the higher side, 19,750. So this could be a possible range for some couple of trading session. As most of the call writers are taking their position in the range of 19,600 to 19,700, and on the downside, the put writers are active at 19,400, 19,500 strike. So it clearly indicates that we are going to have a range-bound trade setup for the Nifty. So to play this range-bound behavior of Nifty, we are initiating here short straddle for Nifty for a strike of 19,600. So by doing this short straddle, writing of call option of 19,600 as well as a writing of put of 19,600. So you are pocketing almost 128 rupees as a premium for this option expiry, weekly option expiry tomorrow. We are keeping a stop loss of 175, and on the downside, we'll cover our position when these premiums are shrinked to 25 rupees. We are projecting that Nifty is likely to expire around the 19,600 or 19,550 band only. So this short straddle may give you good profit in the next one or two trading session. On the Bank Nifty, 45,200 is the important level to watch for in the today's session. If we are able to cross those levels, then short covering action can be there in Bank Nifty, and possibly Bank Nifty can scale up to the level of 45,400 to 500. Most of the banking stock has shown good buying interest in the previous session ahead of RBI policy. On the stocks front, we are bullish on Canara Bank. Good short covering action was there in the previous session. Stock managed to give breakout of 3 days consolidation range. So we are projecting target of Canara Bank towards 350, 355. Keep stop loss of 332. Second stock is BEL, Bharat Electronics. Stock is in uptrend, and since last 3-4 trading session, good accumulation activities happening in the stock prices. Stock is very well placed above all its important moving averages. So BEL is buy for upside target of 135 to 138. Keep stop loss of 126. And the third stock is SBI Life. Very strong breakout in the previous session. Looking at the long build-up, we expect SBI Life can continue furthermore upside towards 1390 to 1400 zone. So one can buy with stop loss of 1325.
Okay, got that. Rajesh, thank you very much for joining in and giving us some trading advice today on the F&O side of things. Well, let's get back to some corporate conversations now. And it was a good set of earnings coming in from data patterns in the first quarter. The company's revenue and profit was aided by other income. However, margins were flat year on year due to higher raw material costs. Srinivasa Gopalarajan, Chairman and Managing Director at Data Patterns, is with us now. Thank you, sir, for joining in. So, I just want to go back to your stated intent of growing the top line at 40%. At 40% margin. So if I look at the Q1 performance, then, it's probably not bad. You've grown about 31% at the top line. Even the EBITDA margin is at 30%. So you're at 30-30, whereas the promise was 40-40 over the next 2-3 years. How do you see yourself progressing towards that guidance?
See, our business is not a quarterly business. It's more year-end business. And the last couple of years, we're trying to average out the business, see that quarter-to-quarter sales is also taking place. So you can't really compare a quarter sales and bottom line business on a yearly numbers. So that won't work out. So what I mentioned last time with you, that this year we'll do more than 20% top line and more than, increase of 30% bottom line is what we're thinking. But this will happen over the next 3 sessions of next 3 quarters.
Could you repeat the top line number? 20% this year?
20-25%. Because we have orders on hand for more than 1,000 crores now. But it depends on what we can deliver this year and what goes to next year. So this is going to go, in the course of the year, we will be able to give you correct guidance.
So 20-25% is growth at the top line level or the bottom line level, you're saying?
Top line. Bottom line should grow far better.
All right.
Okay. Got that.
Well, good morning, sir. So that would mean margins will improve as well from here. For FY24, what kind of a margin guidance could you give us?
We retain this 39-40% EBITDA. I think we should do that. And so margins is expected to go up this year than last year.
All right. Because at the first quarter itself, it's a little lower than that mark. It's in the early 30s. You're saying that it'll be mid-35 to 40%, right?
It will go nearer 40%. Because what happens is quarter to quarter, our expenses are 1/4, but the sales is much lower than a yearly sales. It's not divided by 4 sales. So we are a more year-end company.
Okay. So you said your current order book is more than 1,000 crores, right? What's the exact number?
We bought 1,030 crores, 1,060 crores is the orders at hand. This is actual orders at hand plus orders finalized, negotiated, which is expected in the next couple of weeks. So it's about 1,050,000 crores.
Got that. And what about the order inflows? I remember last year your order inflows were very strong. I think it catapulted to 900 crore, a 3x jump. What's the kind of order inflows that we're looking at based on the bidding pipeline?
I'm not able to say, but it should be above 500-600 crores as we go along. And these are more towards our single vendor contracts and contracts which is already executed earlier. We expect some repeat contracts to happen. We're also bidding for some contracts. Those are tender-based business, so we are not very sure which one will fructify. But expected contracts also should be above 500-600 crores. We should be able to get this year based on previous delivered orders.
Mr. Rangarajan, can you tell us, what segment do you expect the bulk of this growth to come in from? And there's radars and electronic warfare, test equipment, etc. So this year, what do you think will really fire up for you? And apparently, you were also looking at fresh product development, new product development. So, what's happening on that front?
Our main business will come from radars in electronic warfare and in avionics as you go this year. We have raised, one difference what's happening in the Indian market is India is now looking inwards to build products. They were always importing defense products all along. Now the policy framework is very clear that we look inwards in Indian systems to build these opportunities for products. This gives us enormous opportunity for companies like us who actually build products in-house. We do end-to-end product development in-house. Over the last 20 years, we've put in a lot of investment in product development. So this is the reason why we went for a QAP, took about 500 crores. Now we're going to invest this money in build world-class products in satellites, in radars, in electronic warfare, and communications. And once we kickstart the product, we expect the next 3 to 5 years, we should rapidly scale the revenue and the bottom line going ahead. Because we are a product company. And if you have products which can meet India's requirements as against importing or integrating or manufacturing international products, we want to do it on our own. So this is an excellent opportunity for us to really scale the business. We are looking at multiple times scaling the business in the coming 2, 3 years, 4 years down the line.
Okay, just a side question, since this came up in the news a day or two ago, I thought I'll just check. The government apparently came out with guidelines banning the use of any kind of Chinese equipment in drones, which is not your area of business. But since you are operating in defense, are there any China connects in your vendor supply base at all? Anything that we should know?
No,
just from a regulatory standpoint.
Yeah, in defense, we are also not encouraged to buy components from China. So we give an undertaking that there are no components from China. We buy mostly from Europe and US, and not.
Sure. So that's not a sort of a concern, even if policy changes for your line of business, and that's not a concern because you're not anyway buying from China. Got that. Thank you, sir, for joining in. Good chatting. Short call today. We'll hopefully do a longer one as we go along through the quarter. That is data pattern. Stock has done very, very well, up almost 80% this year. Okay, with that, let's go back to the screens. The pre-open rates are in, and we are getting a very flat indication, at least going by the pre-open. Nifty is just about 8 points higher. The Bank Nifty is also not doing much at this point in time. So Darshan, what would be the calls? I mean, pre-open at least is not as bad as some of the global markets were suggesting. What's the 9-10 call?
Well, the 9-10 call is consider buying Glenmark, make it a positional trade.
Mitesh, for you?
I'll go with a buy on PNB with a stop at 60.5 for a target of around 66.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's highlight some of the top stocks that we're tracking. Abhishek joins us to tell us more about PB Fintech. Abhishek?
When Nigel, Macquarie has initiated coverage on PB Fintech with an underperformance rating and a target price of 560 per share, which is, a downside of 30% to yesterday's closing price. Macquarie says that there is a disruptor to this disruptor which is coming. So risk from Bima Sugam could actually be a big cause of disruption to PB Fintech. The regulator wants Bima Sugam to be a UPI movement in the industry. So impact from Bima Sugam could lead to lower takes and market share away from PB Fintech from FY25 onwards. Now, question on target market potential and POSP network actually remains. So their FY27 earning estimate is 25% below consensus and 30% below the company's guidance as well. And valuations of 48 times FY27 PE looks to be on the expensive side. Back to you.
All right. Thanks a lot for that, Abhishek. Well, I'm looking at Coal India. The numbers actually looked quite good. On the top line, there was a beat. And in fact, that's what led to the beat on the operational front as well as on the profitability front. The key reason for the beat, though, was that realizations did come in much better than what the street was working with. So we have Novoma's estimates. And the blended realizations, well, that was close to around 70 rupees better than what Novoma was estimating. The FSA number as well, that's where the real beat has come about. And that's because of a couple of reasons. One is they took a coal price hike a couple of months ago, point number one. Point number two is their mix has improved because out of their total sales, they're making a high amount of sales to the non-power segment, which attracts better realizations. The e-auction prices, yes, they contracted on a year-on-year as well as on a sequential basis, but they didn't contract as much as expected. Some on the street were working with a number of around 3,000, 3,100 rupees. Well, it came in at around 3,700 rupees. The margins on a year-on-year basis, they contracted a little bit, but that's on expected line because employee costs were higher. They've taken a wage hike, so that was on expected lines. And contractual expense as well was the other one that went up. But all in all, a good set of numbers driven by better realizations.
Let's move on and talk about Adani Wilmar and why it should be on your radar this morning. Mangalam.
Well, there is a report which is coming from Bloomberg which says that the Adani Group is exploring its stake sale in Adani Wilmar. In fact, Adani Wilmar, if you know, is owned jointly by Adani Enterprises and Wilmar International. Both of them own about 44% stake each as of the Bombay Stock Exchange latest reporting. That's not all. The market cap of Adani Wilmar is close to 2.8 lakh crores. And Adani's holding is worth nearly 1.2 lakh crores as of the last close as well. The Bloomberg report says that the conglomerate has been looking to sell part of its stake, for the last few months itself. And this stake sale would free up cash for the Indian conglomerate itself. CNBC-TV18 had written to the Adani Group, and they have said that, there are no comments on offer on this one.
Okay, Manglam, got that. That stock in the pre-open is down about 4.5%. Let's see how it shapes up. Otherwise, things are looking okay. We have, some of these result reactions. The pre-open indicates that Phoenix, for instance, a very good set of numbers from the real estate company. It should start off positive. Happiest Minds could start positive. At least the top line growth was quite smart at 3% plus. And Data Patterns, the company we were just speaking with, another good quarter for them. 30% growth, 30% margin. Market seems to like that for the time being. On the indices, Nigel, as we were discussing, it's absolutely flat. But I think given the challenges and the fact that we're running into an event tomorrow, policy day tomorrow, if we hold the range, that should be good. And the bank nifty, as long as we can hold at least the 50 DMA, I suppose that won't be too bad for the bulls.
Well, that's right. Yesterday, the Nifty Bank did a bit of an outperformance. So the hope is that they continue to do more of the same. However, at around 45,200, which is closer to around the 20 DMA, that's where, in fact, you have some bit of resistance. So on the downside, I'm looking at the 44,600 odd mark because we had a fair bit of writing at around that 45,000 put odd mark. In terms of stocks that are doing well to kickstart trade, well, as we just told you, Coal India, those numbers look quite good. And that's the reason why. That's one of the big gainers in today's trading session. The breadth of the market will be tracked because though the headline index is consolidating, plenty of stocks are doing quite well. Well, we have our first rates that are coming in there, I think, on the Nifty itself. It's a flattish start to kickstart trade. Yeah, we are just getting it in. The bell rings and the first rates come up for us. Yes, so it's a flat start on expected lines, but individual stocks are doing well. SBI Life continues to see its run that we saw yesterday as well. It popped up in trade. Coal India is up close to around 1% or thereabouts. On the flip side, the Nifty Bank, well, that's pulled back close to around 100 points. That would mean a couple of banking names are lower. ICICI Bank, Axis Bank, both of them are a little lower in early morning trade. While in fact, you have a couple of these large IT names as well that are pulling back a little bit. Nothing too much to worry about, but Wipro as well as TCS in the red. So we're holding at around 19,550. The first tick itself did see some bit of selling coming in there, but the breadth of the market is pretty good, with 1,500 stocks advancing for 1,400 stocks that are declining.
Let's take you through some of the mid-cap movers then. GSFC has straight away opened with a cut of about 5.5%. The numbers are weak. The company's reported a revenue decline of 32%. Margins have contracted. Profits are down 80%. And like in the case of chemical companies, this fertilizer name too has opened on the back foot. Brigade is quite weak in trade, and so is IdeaForge. Remember, IdeaForge, numbers were very, very disappointing. Profits are down more than 50%, and the stock is lower by 4%. Adani Wilmar, on the back of that Bloomberg report about a possible stake sale by the Adani, parent company, Adani Wilmar is down nearly 3%. Prestige's numbers look pretty okay, but then we already had the operational update in. PB Fintech, Macquarie initiated coverage. They've got an underperformed rating, and PB Fintech is a bit subdued in trade. Oil India opening on the back foot. On the gaining side, you've got Phoenix Mills, that's higher in trade, of 50% plus top line growth. Data Patterns numbers look pretty good. The company is guiding for a 20 to 25% top line growth. Minda Corp, there was a big block deal which took place yesterday, a clean out trade, and Minda Corp has opened up in the green. EIH, Dhampur, Tilak Nagar Industries, these are some of the mid caps which are reacting positively to their earnings. Gland Pharma is one of the other big movers. It continues with its gain from yesterday. Gland Pharma has opened up 7%, and remember, it was up nearly 20% in yesterday's trade. On the losing side, Utkar Small Finance Bank. I think it's the first time post the listing that we've got the numbers. Don't look pretty strong. But, at the index level, things are very quiet. Just down 0.07, 0.08%.
Yeah. Gland Pharma is really the stock of the morning once again for me. Its re-rating has been nothing short of breathtaking. 20% yesterday, 7-8% again this morning. Market's extremely excited and really hopes that what we've seen in Q1 is a bottom for the business. So that is straight away stock in focus. Otherwise, the problem area for the market really are banks all over again. You had that one promising day yesterday, as Nigel was pointing out, where the Bank Nifty was finally outperforming the Nifty. Today, you've gone back to the same script. Actually, for the market, there are three critical areas. One is the Nifty Bank, where there is weakness. The second is IT. IT is not off to the best of starts this morning. Look at HCL Tech, Wipro, LTI Mindtree, TCS, Infosys. All these stocks are dragging. They're not down too much, but they are down between 0.25% to 0.5%. So need to watch for IT, need to watch for banks, and then there's Reliance. So three problem areas for the bulls this morning. Let's see how each of them behave. In terms of the counters, it's actually back to, the old-fashioned safety, which is FMCG and pharma. Reddy's, Sun Pharma, these are names on the upside. Britannia is managing a bit of a gain. Nestle. So FMCG, pharma up. Banks, IT, Reliance need to watch. The bank nifty at 44,840. The 50 DMA, which is sort of your first next support zone, which people will talk about, that comes in closer to 44,700, 44,690, 44,700. So we're still 150 points away from that support zone. Let's see if the Nifty Bank can find some stability. We have Mitesh joining in. Mitesh, actually, before we talk about the market, can I throw Gland Pharma at you? I don't know if you sort of had the time to notice the move yesterday. The fundamental news is out and we've been discussing it ad nauseum. But on the charts, I mean, is this looking like there's some sort of a more durable move that could be in the making?
Very much, Survi. In fact, yesterday you couldn't have missed the stock. I think the way it was, attracting attention, big gap up opening and then circuit up as well. I think the stock has definitely changed the medium to longer term trend, and the targets now on the upside would be 2070 to about 2200. So these are the two levels which I'm watching on the upside, which gives us a significant upside. The only worry is the 28% rise which the stock has already seen in this week, and therefore you might not want to buy it immediately. Maybe accumulate slowly, buy about 1/3 or 40% quantity over here, and then wait for levels closer to 1600 to enter afresh. I think the stock is heading towards levels of around 2070 to about, and then even at 2200 as the targets for the next few weeks. So very, very positive over here. The thing is that tactically you would want to define your entry well.
Mitesh, do you think the markets are just waiting for cues in the form of the RBI policy, the US CPI inflation to get some direction? Or do you think we're in for a longer period of time correction, a consolidation which is going to last a little bit longer? What's your sense reading the charts?
I think Survi and Rima, an event like that could definitely, in the short term define a trend. So the initial feeling is that this looks like more of a time-wise correction. And while, I'm looking at lower levels, but I'm not looking at very deep cut over here. So my sense is that we might actually get to about 19,400, 380, which is a level which we already tested last Thursday. And maybe, in the worst case scenario, 19,200. So as of now, looking at 19,200 as the lower end of the range and about 19,800 as the upper end of the range. So then we'll get into some kind of a sideways consolidation once this pull back to about 19,200 plays out. So I don't think, initial feeling is that I don't think that we are looking at a bigger trend reversal, but an event is always an event which could, which has the power of changing the short-term direction. So for the timing, the initial feeling is more of a time-wise kind of a correction, but then let's see how the event plays out.
Okay, by the way, we need to watch out for PB Fintech. Let's put it up on the screen because on my screen, stock's still down another 4%. Remember, PB Fintech sold off very sharply yesterday after numbers, which look kind of all right, but the market has other worries on its mind. Stock's down 4% today. And those worries have been very properly sort of, spelled out by Macquarie in that note that Abhishek was just telling us about. What's the worry? The worry is that you will get a big government set up entity or basically a public entity which could be a disruptor when it comes to selling insurance online. Bima Sugam, I think that's the name of this architecture. If it comes out, if it's a UPI or ONDC kind of an architecture, then can it really disrupt the business? Macquarie is saying their earnings are 30% below street and 30% below what the management, the PB Fintech management itself is guiding for. So this is a note that really stands out loud in today's market action. Mitesh, technicals, stock has had a dream run. It's the best performing internet platform stock in the last 1 year or this year, very, very easily. Let's put up a 1 year chart on PB Fintech. And now suddenly there's a lot of selling coming in. What are you making of it?
Well, again, Survi, I think this is one stock, which went through correction from listing highs of about 1,400 to as well as levels of around 380, 370, and then gave a bigger trend reversal. Now that movement started from sub 400, took the stock to about 800 plus level. I think the first leg of up move in the longer term chart seems to be over and the stock would go into some kind of correction, pullback, consolidation, etc. The first level I'm looking at is around 700. And if it breaks that, then in the worst case scenario, I'm penciling in about 660 kind of level. So the long-term charts remain very healthy, but in the short term, the stock was extremely overstretched. So I think some gains have to be pruned out. And this looks to be a situation when the stock will go to 700 to about 660. That again will be a very good entry point for people who are into long-term investing. I used to hold the stock earlier in my portfolio, but I think now I've just taken profits 2 days back. And now I think it's giving me the chance to re-enter again.
Okay, so all right, stay invested. Basically, buy back in around 700. That's the advice coming in from Mitesh. Mitesh, got that. Thank you. You have a good day. We'll connect later and get some more inputs on the market. Well, that's a lot of technicals. Market, by the way, Bank Nifty continues to be the problem area. That is the index, which is down about 0.3%. Let's get to fundamentals then. Ashwini Agrawal, founder and partner at Demeter Advisors, is with us. Ashwini, good morning. Great to have you on the show. We're in an interesting market. Indices trying to hold on to these near all-time high levels, which is 500 points shy of that 20,000 mark on the Nifty. But there's a lot of chatter on the horizon. Global issues, US banks, China data. We're running into a policy. What do you make of all this? And is the construct for a continuation of the up move? Or would you say that, probably it's time to consolidate a bit?
So, we should think about it. We've had a very sustained run from the end of March. It's almost 3.5 months long, which is very long as a minor bull cycle goes, and we haven't had any meaningful correction during this period. The narrative has significantly changed in India's favor in the global context, which has obviously attracted a lot of foreign capital. But at the same time, if you think about the fundamentals, the earnings direction has kind of either kept pace or in some places fallen short of expectations. Even if you look at the June quarter results that have been released till now, I fail to find too many spots outside of banks and financials where there have been meaningful positive surprises from the underlying expectations. As you point out, that the global narrative is starting to get a little more iffy, and with valuations having become stretched and the earnings environment not delivering that many positive surprises, I would venture to think that we are in for a reasonable correction. Now, whether it will be a time correction or whether it will be a deeper one-step correction, only we'll find out. And it will be driven by an event that we can't forecast. But I think the fuel for a rally to 21,000 or something along those lines, or 2,500, it's not there. It's not there, at least in my mind.
Ashwini, why? I thought pharma numbers look quite good, right? Whether it's Sun Pharma, Mankind Pharma, Gland Pharma, of course, the kind of re-rating it's seen in the last 2 days. You've been bullish about pharma. I remember in a previous conversation, you had spoken about how you would tactically allocate some money to pharma. Your thoughts on the pharma numbers, and have you topped up your exposure given the positive surprise?
So, Rima, you're dead right. Okay, and I was kicking myself for not having bought as much pharma as I should have. It's the single largest exposure that I have in terms of a sector exposure. But there's nothing like hindsight to tell you that one should have owned more. I've been quite positive on pharma for a long time, for about 1.5 years or so, and it's been painful going for a lot of that period. But it's very heartening to see, the kind of earnings flow, fundamental information that's coming through about pricing environment in the US and so on and so forth. In the midst of valuations which have been actually quite attractive across the board. So I continue to feel fairly positive about pharma. And you're right, the earnings flow in pharma as a sector has also been on the positive side. Compared to what the expectations were. Gland Pharma, which is something that I own, hasn't done anything spectacular in the June quarter, but the expectations were so muted and so beaten down that the market's reaction to those numbers has been astounding. We must remember that, the stock had actually been offered to the public at 1,490 almost 3 years ago. Went up to 4,000, came down to 1,000, which is a steep fall. So I think somewhere pharma is a situation where earnings are fine, in line with expectations, slightly ahead. But I think the market sentiment was too beaten down, and it's the correction in the market sentiment which is leading to these very sharp rallies in some instances.
Just to get that point clear, pharma is your single biggest sectoral exposure currently?
That's correct. That's correct.
Okay, so more than banks, more than any other, manufacturing is a big theme
That's correct.
Okay, interesting.
Hi Ashwini, good morning. Good on you that you got that pharma call right. Must be feeling good, right? I mean, Gland Pharma, the stock in May. If I just take a look at the low then and the high today, it's doubled. So you would have been somewhere in that vicinity. So good on you. But I was more concerned about your starting comments that maybe in fact we are in for a correction, a price or a time-wise correction. Time-wise, I think that's fine. But price-wise, what would be your best guesstimate? I mean, in terms of, since most of the positives have played out and we're running a little bit less on the, on fuel to take us to 21,500 odd. So what would be your guesstimate? I mean, could we see a 5%
I have
correction?
no idea.
That would be part
Nigel,
of the
I have Nigel, I have no idea. I wish I could tell market direction as accurately as you believe I may be able to. And if it was the case, I could make fortunes. But I have no idea. I can only tell you that, look, the fuel doesn't seem to be there in the tank anymore for the market to take Nifty to 21,000 or 20,500. Because in terms of fuel, what we need are either a beaten down sentiment, what we are seeing, fuel the pharma rally, for instance, or you need, a significant earnings momentum, which is way ahead of expectations. We are not seeing that. Or you need a significant underweight in the asset category on part of one investor base. None of it is there. So how can we expect a huge rally? So if we can't expect a rally, we should expect a decline is my simple logic.
Okay, all right, Ashwini, we appreciate you joining in, and maybe we could be in for a bit of a corrective or maybe a consolidative phase. Appreciate you joining in and giving us those views, and take care. I believe you're down with a bit of a throat infection, so please take care of yourself. Well, let's move on. Let's focus on Hindalco. Well, the company reported a good operational performance. It was better than what we were working with, despite some challenging environment. Their aluminium business did not see compression as the street was expecting. To understand about the performance of the past quarter and the way ahead, I caught up with the MD, Mr. Satish Pai, and started by asking him about the price outlook as well as the aluminium business EBITDA per ton outlook. Let's hear him out.
Why we continue to perform is that I think the most important thing is our costs are moderating. So in Q1, our costs came down by 2% versus Q4, and we think that the costs will come down another 3% in Q2 versus Q1. So whereas the LME, I think, is going to remain range-bound between 2,100 and 2,300, if the costs are coming down the way we said, we should be able to maintain that $700 per ton EBITDA levels that we delivered this quarter as well.
Okay, all right. So that's pretty good news. So we got one variable, that's the cost cooling off. Out of your total quantity, could you tell us what is the hedging policy? We just want to get an updated number. How much of your quantity is hedged? At what prices? That'll give you some cushion as LME prices have corrected a little bit.
Yeah, I mean, there's been no change in our hedge position because the LME has come down. So we have about 11% hedged at $2,755 a ton. And with these current levels of low LME, we have not added to that hedge position rate.
Got it. All right. So that is status quo. The copper business, that was a pleasant surprise. We were chatting the last time as well. You said there'll be a bit of a shutdown, but it appears you'll have sourced copper cathodes from outside and then converted it into CC rods. And that's what's helped the profitability. Now, given that the plant is up and running, what can the EBITDA per quarter look like from here on? In the past quarter, you've surprised with an EBITDA of around 530 crores. From here on, what's the run rate?
Yeah, I think that, look, the first thing we have to realize is that because the copper demand in India is extremely strong, because of the electrification drive, etc. So that is why, to meet our customers' demand, we imported a lot of copper cathodes, converted it to rods. So I think going forward in Q2, you should see an EBITDA much better than in Q1, more near the 600s, because we are going to be using our own cathodes.
Correct. Novelis as well, good improvement out there. It's improved from those low levels. Give us a couple of numbers. The EBITDA per ton, you tell us that in quarter 4 it will return to normalized levels, that $525 per ton. But in the coming quarter, what should be the broad range of EBITDA per ton? And also for the second half of the year, on an average, what will Novelis' EBITDA per ton look like, given that destocking is almost done and dusted?
See, we are now, last Q1, we ran at $479 per ton. So I am fairly confident that in next quarter itself, we should be getting close to the 500. And I think that that is going to constantly get better. So we have guided that by Q4, we will reach 525. I wouldn't be surprised if we reach it in Q3 itself.
Wow, that's quite optimistic. Then the street will like all these sound bites that you're giving us. Aluminium EBITDA per ton closer to around $700. Copper moving to around 600 crores on a quarterly basis. And Novelis, that could be a surprise. Maybe that 525, we see it earlier than what we thought earlier. But that brings us to the debt number. Operationally, you've given us a fair bit of guidance. The debt number, well, it moved up a little bit because working capital went up. Also, you have capex plans. So what should the absolute debt number look like, say, by the end of this year? And also, if you could, revisit the capex plans, both at Hindalco as well as at Novelis.
See, our gross debt, or the Indian gross debt, is roughly around 12,000 odd crores in the long run, long-term debt. We have not increased that. So, as you said, the total debt looked a little bit higher because working capital block was there in Q1. And that was largely because of the copper side, where we had to import these copper cathodes. So it led to a little bit of working capital block. So we have no intention of adding to our debt lines. And I think that the net debt to EBITDA by end of this year will be back to, we ended last year at some 0.33. We are going to be in the similar range at the end of this year as well.
Correct. All right. There's been a lot of excitement on Hindustan Copper. Now, there will be various reasons from that company's point of view. Maybe they're doing a bit of management change. Maybe there's far more demand. Well, time will tell. But since, you could be one of the possible buyers out there, and you have said in the past, if it's offered, you'll be interested. Has there been any movement on Hindustan Copper?
Not yet. As I said, whenever the government decides to do anything, we will be interested. But nothing has happened yet.
But there's been no movement whatsoever, because for the past couple of quarters, you'll have been telling us that if there is an opportunity, you'll be interested. But there's no movement whatsoever?
No, not yet.
Okay. All right. What about Vedanta's unit, the Tuticorin unit that possibly could have been up for grabs? Have you looked at that one?
Not really.
Okay. Let's wind this down then with the capex plans for the year. You just want to revise that. I think it was 5,000 crores for India. And for Novelis, I think it was around $1.8 billion odd. Any change to those numbers?
No, there's no change. I think that, we most of the projects are ongoing. We have a strong balance sheet. We have the cash flow. So we will continue with our capex plan exactly as you stated. So no change there.
That's the big voice coming in from Hindalco. Let's move on and talk about Shobha. Now, Shobha Developers reported a good set of Q1 earnings. The numbers came out 2 days back, but we already had a sense of the numbers given the Q1 operational numbers. It's the fifth consecutive quarter of record high bookings. Pre-sales jumped up by 28% on a year-on-year basis, and realizations have improved very sharply, A, due to price hikes, and 2, a change in the product mix. The company is now selling far more luxury homes, which has helped boost their realizations. To discuss their Q1 performance, we're joined by Jagdish Nanigenini, the MD of Shobha. Thank you very much, sir, for joining in. Let me talk about your high-end segment. The way your product mix is changing towards premium is very staggering. It's happening at a phenomenally fast pace. I believe your high-end segment is now nearly half of your sales, and this number was about in the mid-30s in FY23. Can you tell us the growth that we're seeing in the high-end segment? What will be the split going forward? And what are the margins that you enjoy on the high-end segment, the luxury space?
Thank you. Thank you for having me on your show. You're right. We had the 8th straight quarter in which we did sales better than the previous quarter, and which is in this quarter specifically, it's even better because we didn't have any new launches. Our teams across the country have done a phenomenal job at it. The performance especially is due to a combination of 2 factors. One is our geographical diversification that we had, where we have inventory in 11 cities. And second is due to the change in the mix, like you have observed, from the mid-luxury to a slightly high-end luxury segment. This change, and hence due to this, we have crossed for the first time 10,000 rupees average price realization mark in this quarter. The mix is also because we have seen the trend of larger home sales early on, and we could change our mix in our own design, and that has helped us. And second is also the you have seen that more than 3 crores ticket size, which is contributing 37% of our sale in this quarter. About 2 years ago, that was less than 5%. So that change in the mix has worked out really well for us.
All right. Hi, Jagdish. Good morning. Well, you must be feeling good, right? Good traction on ground. Inventory levels are lower. Launches are being picked up. But as you said, in the first quarter, there were no new launches. But do you think, going by what you have done in the first quarter, you'll be able to exceed the 15-20% pre-sales growth that earlier you were guiding for FY24?
Well, we aim for the best numbers, Nigel. But like we had been anticipating good set of launches this financial year, and hence we thought we could do those numbers. Some of the launches are slightly delayed now. So, but still we would try to achieve those numbers. But it is all dependent on, like I had mentioned in the investor call as well. It is all dependent on our ability to do new launches.
Okay, so would that mean that you can, deliver on your guidance of 15 to 20% pre-sales growth? I think that's the guidance for this year. Are you on track, or given the traction that you're seeing so far in the first quarter, you think you can maybe even do better than 20%?
I think we are mostly on track for trying to do that. It's very tough to predict for the next 3 quarters, given the nature of the launches and the timelines for it.
Last year, I think your sales were 5.6 million square feet. In the call yesterday, you've laid out a medium-term ambition of 8 million square feet. What's medium-term? Do you think it will take you 2 years? Do you think it will take you 3 years? Or maybe even longer?
So we have been seeing, we are in the 8th straight quarter of increased sales, and we did about 5.65 million square feet last year. This year we would like to better it, and we would like to be a consistent performer with balance, with where we have a balance of growth and profitability. Given that, and also we are building up our pipeline inventory to achieve these numbers. So from a timeline perspective, I think it's a little too early to predict as when those would happen. But I'm sure we will reach there. When I say medium term, maybe 4 to 5 years.
Okay. All right, Jagdish, for a real estate developer, and, from the time that I've been looking at it for the last many years, is sales is a very good friend, but debt becomes an enemy. And you have kept that enemy far away from yourself. I think your debt number as we speak is at 9-year lows. Could you tell us what is the trajectory on the debt front from here on? You'll require some funding for new projects as well. So where does this debt number move up? Do the promoter entity have any kind of intent to pump more money into the company?
Yes, Nigel, we have a very laser sharp focus on our cash flow generation, and due to which we have the 11th straight quarter of debt reduction and net cash flow generation. We are at almost half the levels of our peak debt, which was in FY21. And this has really helped us in improving and financial structure of the company. And we believe going forward also we have very good pipeline of these the inventory. And as a company, we have been in the business for more than 28 years, and we think that we are very well capitalized, and we have done investments in the past, which we can reap those benefits in the coming years. And due to those cash flows, those we should be able to use to fuel the growth in the future, and also keep a cap or reduce the debt further.
Okay, so can you sort of lay out that roadmap for us? I was just going to get to that point actually. What is a debt equity ratio that you'd like to maintain on a going basis? You said that there's more cash flow coming in and you could reduce debt. So what number could it go down to? What is a comfortable debt equity position? And then what about funding for future growth? I mean, whether it's buying land and your other investments as you're looking at the launch pipeline, how will you sort of look at the cash and the investment for that?
Well, like I just mentioned, the cash flow that we are visualizing from the new inventory that will come in, that should largely fund the growth for the future, and hence our ability to manage the cash flow and keep the debt at these levels should be fairly good.
Very quickly, Jagdish, in Q1, the blended realization went up by 25%. Partly it's on account of the fact the company is selling more premium projects. But you also undertook a price hike, 17% price hike in Bengaluru, and Gurugram prices, I believe, went up by 40%. Do you think, the company will be upping prices again in Q2 or Q3? What's the view on price hikes from here on, and in which markets?
We are not here. Actually, stable pricing and incremental inflationary-led pricing is what we are happy with. Like I said, in the first stage of price increases had occurred in post-COVID when the costs for the construction have significantly increased, and across board the industry had to take price hikes. And this mix has come in wherein we had to increase we could manage better pricing because of the mix in the projects. We are not necessarily seeing a price hikes from here on. But at the same time, due to the mix in the change in the nature of the projects, if the average realization improves or remains steady, we'll be very happy with it.
Okay, got that, Jagdish. We will leave it on that note. That is Sobha at the end of the first quarter. By the way, got to turn our eye. Thank you. Got to turn our eye to the screen as well, because there is a wider decline that's now setting in. No taking away from that. The Bank Nifty is absolutely at that 50 DMA. We're at the day's low. Now this is looking like a weak morning, decisively weak morning. Nifty, mid-cap, Bank Nifty, all indices are lower. And for the Nifty, the problem is not only banks. Banks are down, yes, but as we were saying earlier as well, IT is not providing any support. A lot of your large-cap IT names are down. Reliance is down. And the biggest of the FMCG boys, Lever and ITC, they're not helping matters either. So therefore, now this is a bit of a downward draft coming in for the market. Let's see if buyers come in right now, 19,500 odd for the Nifty. Let's take a break on that note. We'll come back on the other side. We'll keep the corporate conversations going. Kamal Gupta, MD at Jaykumar Infra, is going to talk about the company's Q1 performance. We will also be connecting with Sanjay Kumar Jha of Mishra Dhatu Nigam to talk about the company's show in the first quarter. Welcome back. Well, the screen's looking weak. We've been pointing that out. So we've got an eye on the Nifty and the Bank Nifty, but we also have more corporate conversations to go over. The next company on the radar is Jaykumar Infra. And that one came out with a pretty strong set for the first quarter. The company witnessed order inflows of over 3,500 crore rupees in Q1. The total order book now stands at above 14,350 crore rupees. The Inframajor expects to maintain the revenue growth of 15% as well as the EBITDA margin band of 14 to 15% in the current fiscal. Kamal Gupta, MD of Jaykumar Infra, is with us. So, Mr. Gupta, we've already spelled out the numbers. Revenue up 14, margins at 14.2, profits up at 18%. So tell us what the outlook is. As you're looking at execution, in terms of top-line growth, what more can we expect this year? And how's the bidding going for future contracts as well? So what's the order book outlook as well? Kamal, I think you're on mute. Yeah.
So sorry. Yeah. Happy to share
Yes,
another
go
healthy J. Kumar. As you are aware and you told, like we have got a very excellent and one of its kind project in Chennai, which is a connector of Chennai port to Madura well, which is a double ticker access controlled elevated highway and divided in 4 packages costing 3,570 crores. Taking to this, our order book today stands at like 14,351 crores. And we are very upbeat about the order inflows. Our guidance for this year looks to be 15% plus, that is 4,800 crores. And we are on a comfortable journey towards our vision for a $1 billion revenue company by FY27 with an order inflow of like order book of 20 to 25,000 crores. So
wait,
the market looks very good, and like I can feel the air in the air. There is optimism in India, though the world is struggling with other uncertainties. So we are very upbeat and prepared for bigger challenges. J. Kumar is looking for bigger ticket size projects and more complex projects with a healthy balance sheet.
Kamal, just to clarify, you mentioned your order intake target for this year is a number just above 5,000, if I got you correct, right?
So our guidance initially was 5,000. So we revised our target, and we are anticipating an inflow of around 8,000 crores.
Exactly.
Thereby to maintain an order book of around 15,000 crores by the year end of FY24.
Okay, so order book, order intake guidance for this year now stands revised to 8,000 crores, given that the first quarter itself has been pretty strong. Rima?
Would you like to revise your top line guidance to 15% higher?
We would like to give a conservative figure, but of course, we also see there will be the speed of the projects are improved, the margins will also go better. We are already L1 in more than 4,000 crores of project, which also includes the Goregaon-Mulund Link Road project, which is a twin tunnel. This will be the biggest road tunnel TBM machine in India, which is around 13-meter dia. So our share will be 3,100 crores. So of course, we are expecting a positive uptake in the guidance. So maybe it will go up than 4,800 crores.
Okay, all right. Mr. Gupta, since we were just talking about the TBMs, that's the tunnel boring machines, you'll be using them from line 3, but I think the Mumbai tunnel project could require bigger TBMs?
So we already have Nigeria 8 tunnel boring machines, which are used for metro, 6.3 meter dia. So this project of JMLR will require a 13-meter dia, which is the road tunnel. Correct. So this will be the biggest TBM in India as of now, Nigel. So we have to buy that. We have already placed the order.
What is the total cost of that? I mean, and how many machines will you have to buy?
So this project is in JV with NCC. So 2 machines will be required, 2 TBMs. One will cost around 350 crores.
Right.
What are the kind of margins? You said the revenues, your share of the revenues will be 3,000 crore rupees for this Goregaon-Mulund Link Road Tunnel project. What would be the cost, the kind of margins and the timeline? How long will it take and when will construction begin?
So as you believe, we only take projects with 14 to 15% EBITDA margin. So we believe in a profitable growth. The timeline for this project is 48 months. We are expecting the LOI in another 10 days, a week or 2. So immediately after that, the work will start. It will take around 3 months to actually start the revenue from that project. But the mobilization and the planning has already been started.
Okay. Yeah, timelines for us, especially in Mumbai, are very, very important, Kamal. I can tell you, for a lot of us, we keep seeing your boards everywhere in the city as we travel. So really hoping that those projects get off the ground ASAP. But, I want to move to a different subject as well, and that is the sort of margins that you're getting. We understand that overall, the competitive intensity has really picked up in bidding. Tell us if you're also looking at that, if you're experiencing that. And in that context, going forward, when you shared an order intake target of 8,000 crores, which segments would you be targeting, not just this year, but even next year? Where are you still getting better margins? Is it metro? Is that the most profitable business? Will it be roads, tunnels, bridges?
So we work in a very niche area. We believe to take more complex engineering projects. So we are more into flyover, bridges, metros, elevated, underground, hospitals, water, tunnels, roads as well. So I would like to say, like, I cannot say that this particular sector or this particular segment will generate more revenue. But of course, since we are working in a very niche area where the competition is comparatively less, and not like in roads. So, we are sure that we'll be able to maintain our guidance of 14 to 15% of operating margin. And all our projects right now, what we have secured are with 14 to 15% of margins.
Okay, all right. Mr. Gupta, thanks so much for stopping by, giving us that guidance. You're sounding extremely confident. The stock has moved to the high point of the day, so your shareholders will be happy. But all the three anchors out here are Mumbaiites, and we are hoping that, the construction, the activity, the execution picks up pace, because we are looking to more smooth travel rather than the trek that we normally see.
I stay in Parel, and there is this Delisle Road Bridge, okay? It's been under construction for 5 years now. And the deadline to open it has been pushed twice. So you can imagine the nightmare. That's the reason why Lower Parel is called Lower
I'm in the
Parel.
western suburbs, and if we keep talking about this, we'll have to do a full 1 hour show on Mumbai.
And we will all complain.
That's what the director told me. Don't get Surbi started. Okay, all right. Well, that's about Jay Kumar, sounding very, very confident. The stock has moved to the high point of the day. But a stock that's trading a little bit lower is Midani. That's Mishra Dhatu Nigam, because the company posted a good set of numbers on the top line. However, margins contracted, and the stock is trading at a 52-week high. So that's why we're seeing some bit of a pullback. They're sitting on an order book of close to around 1,400 crores or thereabouts. So understand what's the way ahead. Mr. Sanjay Kumar Jha, the chairman and MD of the company, joins us on the show. Hi, Mr. Jha. Good morning. Thanks so much for joining in. Well, good execution is what we have seen in the first quarter. Now, the last time you joined us, you said that in the coming year, we're definitely going to cross that 1,000 crore odd mark. So wanted to ask you, for FY24, do you stick to a revenue growth target of around 20%? And also tell us, what should the margin band look like? Because that has disappointed the street.
Yeah, first of all, you can see in the first quarter, our sales have grown more than almost 60% higher revenue compared to the last quarter of earlier last year. But as you said about the pressure on the margin is mainly because of the raw material costs have gone up. So this year, this has affected in the quarter one. And many products which we have done in this quarter is all high-end products where we are importing the raw material at a higher cost. So mainly because of that, the margin is less. But as I'm sure as we progress in the coming quarters and all, we can recover this. And mainly other one is that finance cost also has gone up because of the high interest rate, which is already there for every company. So these are the two regions, I think, mainly, which has resulted in this type of lower profit. But I am sure that these things we can recover.
Mr. Jha, you're saying that the past quarter was impacted by raw material costs, but you're confident of a recovery. So give us a couple of numbers then. Revenue growth for FY24, will it be 20%? Will it be more or will it be less? And since margins will recover, what is the band we should work with? 25%, late 20s, early 30s? Give us a broad band, a 200 basis points band.
See, this quarter also, if you see, our EBITDA to sales is 25% more, 25.64. Last year it was around 35%. So 25% also is not a bad figure, but only since this company was going always more than 30. So expectations were higher that it should be around 30. So now at this time it has come 25.64. That is the first thing. Secondly, the growth, sales growth itself in this quarter has been very good. And I am sure that this year, since you can see our order book also has improved in the last quarter, that means the first quarter of this current financial year, we have almost booked more than 500 crores worth of orders. So order book also is going up. And I am sure that in coming quarters, you will see that if the same trend is maintained, 20% growth is not impossible. Definitely will cross 20%.
Got that. Mr. Jha, can you split the order book in terms of defense and aerospace? And secondly, in February, it signed many MOUs during the aerospace show. Have those orders been converted?
Yeah, in fact, the order book position today, whatever order we have booked in the current this quarter, mainly it has come from the defense. So defense, when I say defense, it includes the aerospace also. So already that part is there, and second part is that export has indications are good. We have got, if you see our export figure, even though it is in numbers, it is hardly only more than 4 crores, but it was last quarter of the last financial year was first quarter of last financial year was only 2 crores. And I am sure that the type of order book we are having today of more than 35 crores, I am having the export order booked. So that will be also adding to our the earnings or the revenue in the coming quarters. So I am sure that the defense is going to contribute a lot, and defense excludes the aerospace also. And in addition to that, export is this financial year export is going to contribute in the big way. So these are the two, I think, factors which will be responsible for the growth of the company.
You said exports are 35 crore of order inflows in the current quarter?
Yeah, already we have the order in hand, 35 crores. And we are trying to negotiate with more than 100 crores order is, and we are trying to negotiate now.
Okay, so what should be the ballpark mark in terms of exports as a contribution of your total revenues?
This year we are targeting around 200 crores of export. It should be around almost 15% of our revenue.
Okay, 15% of revenue. Got that. You briefly mentioned, sir, that borrowing cost has gone up. I'm guessing your working capital as well would have got stretched. So what's the working capital days? I think towards the end of last year it got stretched a little bit.
Yeah, working capital is the issue for us because of the inventory level is quite big. Because of that's what we are trying to see, that our inventory should come down, our work in progress should come down. So that efforts are on. And since our many products which we are supplying requires a long gestation period, processing time is long. So normally if you see in the quarter 1, quarter 2, you'll see the buildup of work in progress will be there. Otherwise, we cannot meet the requirement of quarter 3, quarter 4. So this is what it will be, variation will be there because of our products are very niche in nature. So because of that only this pressure will be there.
Final question, Mr. Jha. You know, if I just pull up the last 1 year chart of the stock price, when it was around 200 rupees, when it was 250 rupees, 300 rupees, and now it's 350 rupees. I've asked you, the largest shareholder, could they be interested in doing an OFS? You have replied to me saying there is a possibility. Have you heard any kind of sound bites on that front? Is an OFS likely, say, in the coming quarter? Because the share price has gone up drastically. And as you said, FY24 could be good. So have you got indications from the government of India?
It is under consideration.
But it was under consideration, sir, the last time as well. So is it likely in the coming quarter?
I am sure maybe this financial year they may go for that. But we are not having the control on this. Is done by the policy makers and then government of India. So depending on the market position, they will take decision. And I think that not only that Midhani, many other companies are also in the queue for OFS. So it is expected that any time it will come.
Okay, we will watch out for that announcement. Thank you very much, sir, for joining in and giving us some details on the business today. That is Mishra Dhatu at the end of Q1. Back to the markets, which are sort of reeling under a bit of pressure. Mitesh is with us. Mitesh, what's the call? What's the strategy now, looking at this weakness?
I've been kind of suggesting that there could be pressure from the higher side, and you could see some profit taking happening, and Nifty and the Bank Nifty could, see a lower level. So I'm penciling in about 19,400, 380 as the first target area for the Nifty, and if that breaks, in the worst case scenario, 19,200 can also be visited. So I think that's the kind of downside which is possible. On the stock side, IT still remains my favorite sector to explore long positions. So Tech Mahindra is a buy with the stop at 1195 for targets of 1250 on the upside. And a sell on TVS Motor, which I would recommend selling with the stop at about levels of 1335 for targets of around 1280.
Thank you very much, Mitesh, for joining in. Need to get into a short break. On the other side, we'll put the focus on commodities. Manisha Gupta is back with us.
Welcome back. Slightly weak cues from equities. Let's figure out what's happening in the commodity markets. Manisha is with us now. Manisha, what are you tracking? What's top of mind?
Well, I'm looking at the crude oil prices. So with all its ups and downs and volatility that we have seen in last many days, it still continues to hold around that 4-month high. So $86 a barrel is still on the charts here. We have seen prices move in a range of 1.5% to 2% for last couple of weeks. Now, having said that, it only has been making higher highs in the recent few days there. Well, the support comes in from the fact that Russia and Saudi Arabia are deepening their cuts from August into September, and expectation that they would continue to do that in October as well. That is something that we'll know in the first week of September. But at this point in time, the markets do believe that there is some tightness that could continue going forward. What is not working right now for the crude prices is the U.S. output. That is expected to hit a record high in 2023 as per the latest EIA data. The last time we made a record was in 2019 at 12.3 million barrels per day. This year, the U.S. output seems to be rebounding, jumping back, and 12.76 million barrels per day of a U.S. output. So non-OPEC output in that sense seems to be increasing. The other thing that's not working is the U.S. inventories itself. Well, last week was great because you saw nearly 14 million barrels of a decline, which was a record in itself. But this week, the API suggests that you could be looking at an increase in inventories. The other data that's not favorable is the Chinese crude imports for the month of July. That has declined 18.8% on a month-on-month basis. This is by far a biggest decline because in this year, for most of the months, we have seen the Chinese crude imports on the higher side there. The street is also watching out for the Chinese trade data, which hasn't come in so well. We've seen double-digit decline in exports and imports as well, and much more than what the street was anticipating on an year-on-year basis as well. So whether it's about weak global economic data, the strength in US dollar index, the Fed official statement suggesting that there could be another rate hike because the inflation numbers continue to be on the stronger side, and that's exactly what the street will be watching out for now. More Fed official comments are coming in today and tomorrow, and then you have the inflation numbers. The CPI comes in on Thursday and the PPI on Friday. So those two inflation numbers from US are going to be quite of importance.
Oh, absolutely. It is inflation data that markets will have their eye on. Thank you very much for that, Manisha. Well, let's come back and talk about, of course, the biggest cue that markets pretty much across equities, commodities, and, of course, the money markets will be tracking. The 3-day meeting of the Reserve Bank of India's Monetary Policy Committee has kicked off. A CNBC-TV18 poll shows 100% of market participants are expecting a status quo on rates. Ritu is here with the details.
Well, this monetary policy comes amid a sharp spike in vegetable prices, but easing momentum in fuel and core inflation, steady high-frequency indicators, and a divergent global monetary policy cycle. So the question becomes, what does RBI do amid all of these mixed signals? Well, all of the respondents to CNBC-TV18's poll expect the Reserve Bank's Monetary Policy Committee to prolong the pause and leave repo rates unchanged at 6.5%. In fact, the markets do not expect to see any more rate hikes in this entire financial year. The first rate cut is only expected in the April to June quarter of the next financial year, that is FY25, by 60% of our respondents, with some even expecting the cut to happen in the quarter before or after that. Now, in a status quo policy, markets are not really expecting much on the liquidity stance either. So the stance of the policy, which has remained at withdrawal of accommodation for over a year, is also now widely expected to be left unchanged in this policy. Food inflation is likely to drag the overall consumer inflation higher in July, perhaps even in August. So the CPI inflation forecast for the full year, which is currently at 5.1% on average, is expected to be raised, but only marginally, to 5.2 to 5.5%. The RBI is also expected to leave the growth forecast unchanged at 6.5% for the year. Now, put all of this together with the mixed signals on inflation amid global uncertainty, and the governor is likely to sound more hawkish than not.
And it is that commentary that the market will watch out for very, very carefully. Thank you, Ritu, for the details there. Need to take a break, but we're not going away from this issue at all. In fact, we're putting the spotlight on the RBI policy meeting. Our special segment, It's the Economy, comes up after the break. Lata today gets chatting with Abhishek Upadhyay of ICICI Securities Primary Dealership and R. Sivakumar of Axis AMC.